Hello, my name's Kurt Jackson. I'm a certified mortgage planner in Liberty, Missouri. In my more than 17 years in this business, I've seen a lot of smart people make big mistakes surrounding money. And with that experience, one of our goals is to provide enough information for our clients to be able to make the best decisions surrounding money, especially surrounding their house. Today's subject is for those of you that are thinking about paying cash for your new house. Now, before you pull the trigger on that, I want you to spend a few minutes to watch this video and the second in this series to see if you really want to go through with that plan. The second video will be right below this one on the computer screen. So all you have to do is scroll down and click on it. What we've found is that people like you that have the ability to pay cash for their home do so for many reasons. The main reason we found is that you don't want a mortgage payment hanging over your head each month. In other words, you're seeking peace of mind. Does that sound about right? Almost everyone we talk to equates peace of mind with not having a mortgage on their house. In other words, Americans equate financial security with having no debt. Well, let's see if that's actually the best direction to go. Our research uncovered that the reason people feel this way comes from the fear and hatred we have for mortgages. Owning your house free and clear is a concept that's been ingrained in our psyche since way back in 1929 when during the Great Depression, millions of homeowners with mortgages lost their homes. Now, these were good folks that were paying their mortgages diligently, but due to circumstances surrounding the Great Depression, those good folks lost their homes to foreclosure. See, during the Great Depression, mortgages had what they called demand features. This meant that a bank could call the mortgage due whenever they wanted to or needed to. So millions of good people lost their homes, even though they were making their payments on time each and every month. And this is really where our parents or our grandparents determined that you should own your house outright and that a mortgage was a necessary evil at best. And it appears that we haven't changed our thinking for more than 75 years, even though mortgages no longer have a demand feature and banks are insured by the FDIC, so there's no chance of a real run on them. Without the demand feature, the only way you can lose your house to foreclosure is if you don't make the payments. But somehow, somewhere, some way, we came to the conclusion that having no mortgage on our house gives us some kind of rate of return on our wealth or the equity inside the house. Now, let's make sure we fully understand what having equity in our house does either for us or does to us. First of all, we found that the equity in our house has a 0% rate of return. Well, let me explain why. If you were to buy a $100,000 house at 100 First Street and you paid cash for that house, then you owe nothing on the house and have no mortgage payment. If we assume appreciation is 5%, okay, in a year your house would then be worth $105,000, right? So let's say I had the same taste in houses and I bought essentially the same house across the street from you at 101 First Street. I paid $100,000 also, and even though I had $100,000 in cash, I chose to finance 100% or $100,000 so I could keep all that $100,000 in my pocket. Now, I do have a mortgage and a mortgage payment that you don't have, and I'm going to address that later. But if our houses are basically the same and your house went up 5% over that year, wouldn't it make sense that mine did too? So my house would be worth $105,000 also. So the fact you had 100% equity and I had no equity, both our houses went up $5,000. Therefore, having any equity, even 100% equity, has no rate of return. It has absolutely no bearing on the value of the house, and that's where the rate of return comes from. Now, before we lose you on that idea, let me say that having equity does have some value. That value is in the form of monthly savings, the savings you would have by not having a payment on a mortgage or by having a payment on a smaller mortgage, right? So if I borrowed that $100,000 at 7%, I'd pay 7% in interest over a year. Or I'm sorry, $7,000 in interest over a year. But mortgage interest is normally deductible. If I'm in a 28% federal marginal tax bracket and 6% state, I'm able to write off 34% of my interest, thus reducing my tax bill. Well, 34% of $7,000 is $2,380. So my total cost is only $4,620. Well, that equates to a net cost of 4.62%. So that means that you are saving 4.62% by not having a mortgage on that house. Now, if you gave your financial advisor $100,000 to invest and he earned you a non-compounding 4.62% on your money each and every year, how long would he be your financial advisor? The next thing our research uncovered was that when someone decided to pay cash for their house, they aren't really thinking about what they're giving up if they had invested that money instead of paying cash. We call that an opportunity cost. When you think about opportunity cost, it becomes evident that everything we buy is 100% financed, even when we pay cash. Now, why is that? Well, because when we pay cash for something, we gave up the opportunity to do something with that money. We gave up the opportunity to invest it somewhere else. Now, as we discussed earlier, if you paid $100,000 cash for your house, you gave up the opportunity to earn money on that $100,000. Now remember, in our example, since you had no mortgage, you're saving 4.62% after tax. So putting the $100,000 down means you're saving $4,620 each year. Now that amount doesn't change or grow unless your tax bracket drops or goes up. So the key question you should ask yourself is, how much could I earn if I had invested in that money? Now, through our research, we uncovered a proven formula to make decisions, help you make decisions with money. When we base decisions on these formulas, we then know that we're properly allocating all of our assets. Our formula is called the EPR, the effective percentage rate. And the EPR is really the after-tax cost of all of your debt and the after-tax return on your investments. Now, we've got another video that we've done that goes into much deeper into EPR. But let's say you had a $400,000 to pay cash for your $400,000 house. You've got no debt, and you're in the 34% tax bracket. So your 6.5% mortgage has an EPR of 4.29%. And let's assume that the EPR on your investments is 6.5%. So that means your after-tax return on your investments is 6.5%. If you then invest that $400,000 earning an after-tax 6.5%, you're actually earning $2,166.67 per month. And having a mortgage with a 4.29% EPR means you're paying $1,430 a month. Now that gives you a positive income of $736.67. So if we look at that over a 30-year period, and assuming you kept earning 6.5% in that investment, let's even go so far as to say that you invested your cash flow. That's $736.37. You invest that cash flow every month, earning just 6.5% after tax for 30 years. Well, folks, that gives you $814,556 in additional wealth. Now, so using conservative numbers, you're losing over $814,000 or more than $67,000 per year by paying cash for your house. We refer to this as the transfer of wealth that happens when smart people don't fully understand money. Now, if you're worried about the payments or that you have a mortgage on the house, you still got the $400,000 to pay the loan off if you want. But why in the world would you want to? Because your money is paying your mortgage and paying you $736.37 per month. See, what we've found is that when folks understand how money actually works for them, they stop worrying about having a mortgage, and they end up basking in the glory of knowing that they are beating the banks at their own game. Now, this is where we're going to go on to the second section or the second video in this, so please just click on the video that's shown below here on the screen. Just scroll down and click on it, and you will have part 2 of this video series about why would you want to pay cash for your house.